Hi friends, this is Ramesh here. I'm here to talk about the Peerless Mutual Fund Fixed Income Fund Strategy and Positioning. But before I do that, let me give you a brief background about the Indian debt markets and the debt mutual funds positioning in that. There are three tools on the fixed income side to generate excess returns: market liquidity movements, interest rates, and credit quality. Using the first two, which is market liquidity movements and interest rates, needs a high level of portfolio liquidity. Excess returns are based on market opportunity. The only thing is, market opportunities are unevenly dispersed in normal times. Using lower credit quality offers another excess returns strategy in normal times. However, it exposes the schemes to enhanced mark-to-market and liquidity risks. It exposes the investor to sudden changes in the market, leaving little time to react. In 3 sigma market movements, investor might be forced to be invested longer than expected to protect his capital, as happened last July. Debt mutual funds are the only intermediary exposed to volatility on both sides of the balance sheet. On the asset side, volatility is due to market movement and credit quality changes. On the liability side, volatility is due to investor flows. Insurance is the only other intermediary that has two sides, but there, the liability side can be forecasted using mortality and probability. Now, the interactions of both these sides, the asset and the liability side, only compounds the total risk. And investor behavior is typically to redeem when market liquidity is tight and yields are rising. In addition, there is herd risk. Investors typically invest in and redeem across the mutual fund industry, which increases total risk, as majority of the industry rushes to either buy or sell at similar times. Common sense therefore suggests that debt mutual funds should have a highly liquid portfolio. Characteristics of a low credit strategy portfolio: these rely on credit quality compromises to generate excess returns. Though they do generate industry beating returns but it comes along with elevated risk levels. And these portfolios cannot be easily repositioned in tune with macroeconomic and GDP inflation movements. There also arises an inherently illiquid portfolio, which is not in tune with the volatility of investor flows. It also suffers from liquidity and interest rate changes rather than gain from them. And these portfolios are also unable to capture trading opportunities. All this can lead to long periods of underperformance. Coming to the characteristics of our strategy: there's low exposure to low quality credits in tune with macroeconomic and corporate performance. Our strategy relies primarily on liquidity and interest rate opportunities to generate excess returns. It integrates investor flows and market liquidity movements to identify trading opportunities. The only risk that comes is in the form of uneven returns as per market opportunities, as market opportunities are unevenly distributed. This portfolio is exposed to significantly lower levels of liquidity risk. It also optimizes the use of all three investment levers for a risk-adjusted portfolio performance positioning. The portfolio is flexible enough to be repositioned faster to more than 1 sigma events. We believe this is also more acceptable to credit-aware investors, as it results in higher quality, more confidence among investors, and stabler flows over time. Investors are also less impacted by 3 sigma market events. This revised strategy is almost completely implemented for the Peerless Liquid Fund. Implementation of the strategy in the ultra short and short term income funds has started and will continue to happen over a longer time frame as sudden changes will create volatility. For investors who are investing for a longer time frame, it makes more sense to invest in a high quality portfolio. At the same time, this portfolio is being parallelly positioned in tune with the market outlook. So, in a nutshell, our strategy can be described as better, higher, and faster. Better quality of portfolios, higher stabler flows, faster repositioning to market changing events, and therefore lesser risk. This strategy, we believe, is better tuned to current market conditions. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.